makers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London, in for Francine Lacqua. Now, Japan's Prime Minister to Japan, of course, it is the story of the moment. Shigeru Ishiba says there is no truth in media reports. He will resign. It comes after an historical electoral setback on Sunday and, of course, this trade deal. Take a listen.
During my conversations with former party leaders, Mr. Aso, Mr. Suga, and Mr. Kishida, we all shared a strong sense of crisis for the party's future. However, we did not discuss my own course of action. Regarding some media reports on my resignation, I have never made such a statement even once.
For more, let's bring in Bloomberg reporter Alice French joining us out of Tokyo. So Japan's Prime Minister denying local media reports that he's resigning. Alice, what is going on? We had reports from multiple local newspapers suggesting that he'd had conversations with his aides, that he was preparing to step down, if not now, then in August. What's going on?
Yeah, so we're digesting what's been a very busy markets day here in Tokyo. As you say, we have multiple local media reports throughout the day suggesting that Ishiba might step down as soon as this month. This follows his loss of a majority in the upper house in the election at the weekend. Now, that would leave him and his ruling coalition having to rule the country without a majority in either parliamentary house for the first time since the mid-1950s. So it was a pretty crushing defeat. Now, of course, you know, this news about his potential resignation comes against the backdrop of this huge tariff deal that we heard about this morning. Stocks responding very positively to that today, but the government bond market really not liking this kind of uncertainty over domestic policy. It particularly raises concerns around potential fiscal expansion. The opposition parties that gained seats in the election, several of them pushing for tax cuts. And so this uncertainty around Ishiba's future and what that means for the outlook of government spending really upsetting the bond markets here today.
Yeah, and we saw that spike in yields once again, didn't we? We're seeing live pictures right now, Alice, of the leaders of Europe, of course, meeting with the Prime Minister Ishiba. We're seeing von der Leyen and Antonio Di Costa as well from the European Union, of course, representing the Council and, of course, the Commission in those conversations with the leadership of Japan. Live pictures there out of the Japanese capital, and possibly we'll get some agreements and possibly some deals as well in that meeting between European officials and their Japanese counterparts. There's the Japanese Prime Minister standing there alongside Ursula von der Leyen, of course, on the left. What do we know then, Alice, about the trade deal that's been signed between Japan and the US? You talk about that market reaction. It's been pronounced. The automakers soaring double digits in Japan. What are the details of this deal?
Yes, we woke up to, I think, what's safe to say, a pretty unexpected deal this morning, that Japan will be getting 15% tariffs on all exports to the US, including autos. Now, this is definitely better, I think, than pretty much all investors had expected. We had been expecting a 25% levy on Japanese exports. So this seems to be a good outcome, and has also come sooner, I think, than many people had anticipated, particularly for autos. This is obviously a big tailwind. A lot of investors had already been factoring in at least 20% duties on those autos. We've seen Toyota, for example, saw its biggest rise today since 2008. So a lot of optimism, particularly in the export sectors here. Having said that, you know, the kind of nitty-gritty details of this deal are sort of yet to come out. There is still a little bit of caution about what the long-term implications could be. We know that Trump has said that Japan will be doing a lot of capital investment in the US that could potentially weigh on the economy, obviously, down the line, and could be a headwind for the yen going forward. So I think, you know, traders will be looking to see what kind of details come out in the near-term future, and as you say, how this plays out in terms of negotiations with the EU and other partners, including potentially China as well.
OK, Bloomberg reporter Alice French with the details on a busy day, of course, for Alice and the team. Alice, thank you. Joining us out of Tokyo with the Japanese yen currently at 146.68, just a little weaker so far in the session. It's been volatile, of course, in the last 24 hours. Let's bring in another view now in terms of the global economy on the back of these trade deals, and bring in Katharine Neiss, Chief European Economist at PGIM Fixed Income. Katharine, thank you for joining us around the desk this morning. Do you make the assumption, you and the team at PGIM, that the deal between the US and Japan is a template for a deal between Europe and the US?
No. It would be the short answer. I think in terms of where the Japanese ended up, I mean, we've seen the reaction today, and your reporter discussed this. I mean, clearly the good news is we've done away with near-term uncertainty. The agreement has been better than what was expected. But from an economist perspective, which is the perspective I come from, we are looking at way higher tariffs than what, we started out with just a few months ago. The Japanese levy 0% tariffs on U.S. car imports, and it used to be 2.5. So we are ending up in a place that is significantly higher than what was there before. So there's an element to this story where I feel like we're all being frog spoiled and thinking that this number looks so great, only relative to the initial threats. And my guess is that in that regard, there could be elements, in similar elements in the EU-US trade deal. Maybe we'll end up in a place that looks better than feared, than some of these, eye-watering numbers. But we can't forget that we will probably end up in a place that is significantly higher. I mean, literally orders and orders and orders of magnitude higher than where we started out from. And why it matters so much is that the U.S. and the EU, when we think about trade, we think about China, we've talked about Japan. The U.S. and the EU are the world's largest trading partners. I mean, they are the heart of the global financial and global trading system. And so what gets set there, I think that will be a template really for the rest of the world rather than the other way around.
The markets seem to be reacting to a view that maybe you get a European-US template, or at least deal, along the lines of the one that's been achieved by Japan. But to your point, the levies and the tariffs are being locked in at a much higher rate than pre-Donald Trump's second term. But nonetheless, the equities are on the front foot, yes, and the stocks are on front foot on the back of that. If we do get a similar deal, say 15%, including for those particular sectors, what would that do to your outlook for growth for the Eurozone?
I think my outlook would be broadly unchanged because I set out with an assumption that we wouldn't end up going all the way to some of the heady heights that were threatened, but that we would end up somewhere probably in the middle with carve-outs. Maybe it's marginally worse than what I initially anticipated in terms of the landing zone. I mean, we need to see what that landing zone is, but at the minute, it looks like those negotiations are going less well than hoped. And this is why the EU is now threatening or considering, these retaliatory measures, which they've hitherto been, pretty, They've been pretty calm and collected, I would say, in this negotiation. And so, that could shave, a couple tenths off my GDP forecast. But we're not talking about something that is wildly different to what we assumed going into it. In terms of the market reaction, I mean, my sense is that, markets have a very short-term view. So there was obviously a risk that we would go all the way with these tariffs. That risk has come down, at least for now. And we have a reduction in uncertainty. And the combination of those two things is obviously fueling this optimism. But we mustn't lose sight that the medium term is not good for trade and therefore not good for businesses, because ultimately in the medium term we are talking about higher trade barriers globally as a consequence of these new agreements. And
so that takes us on to cost implications and inflation, with the ECB coming out with their rate decision later this week, of course. If you get a deal, does that sideline the ECB? Markets are pricing in another cut by the end of this year, just another 25 basis points. We're down to 2%. Does a deal sideline and keep the ECB on the sidelines through the rest of this year? So, yes, that is how I would see it. My view is that the ECB is essentially done cutting for now, that we are at 2% and that they will hold there till the end of the year. And maybe you would see another cut in the first half of 2026. If we get a significantly worse trade agreement
than, the 10% consensus or maybe 15%, but something that looks more like 20 or possibly higher. If alongside that you get EU retaliation, then I think you need to bake in more ECB cuts, because then you really will need to be going into accommodative territory. But assuming that worst case doesn't transpire, that we do get something that looks like a halfway house, then I think the ECB are done, at least for the foreseeable future. And
you keep coming back, Katharine, to the point that, look, this is still a much worse scenario in terms of the tariff regime globally. Talk to us about, you've been looking at the way that post-Brexit Britain may be a template for the US. Very different economies, very different sizes, of course. What is the read across? What are the lessons for the US in this environment that they can take, maybe, from post-Brexit Britain?
So, time will tell what the lessons are. What the U.S. is doing is pretty, this is uncharted territory. The best thing we can do is we can try to look out, are there examples? And to me, Brexit probably offers the nearest thing as a potential, comparator. And what did we observe when the UK voted to leave in 2016? We did observe that there was, quite a lag between that vote and what happened to inflation. We had more than a percentage point deviation in UK CPI, Bank of England having to write letters. But it took a year and a half for that peak to happen at, a little over 3%. And then what we observed is that GDP sort of trundled along. We didn't get some sort of a V-shaped hit to economic activity like what we saw in COVID, for example. But what we did see was this slow grind down in medium-term inflation. And this comes back to the point I was making before, that these trade agreements ultimately are not good for potential growth anywhere. And so to that extent, I think the read across to the U.S. is that the inflation hit is going to take some time to impact, and that the growth effect is going to be more of a slow grind down than rather some sort of V-shaped.
OK, and there's the cautionary tale, arguably. Katharine Neiss, thank you very much indeed, on a big day, of course, when it comes to the trade story, but with a reminder of the tariff impact and what it means for inflation and growth longer term. Katharine Neiss, Chief European Economist at PGIM Fixed Income. And Bloomberg Surveillance will be speaking to the US Treasury Secretary Scott Bessent, of course, and Commerce Secretary Howard Lutnick. And later, Senator Bill Haggerty to discuss the economic outlook, the US-Japan trade deal, and lots more. So do tune in for that conversation. Coming up, as London IPOs, meanwhile, hit a 28-year low, we're pivoting somewhat. We're going to speak to the chairman of MHA, which took off after floating on AIM earlier this year. They took the gamble and it paid off. That is next. This is Bloomberg. Welcome back. Happy Wednesday. Concern is growing, of course, about the ongoing lack of listings on London's shrinking exchange. The shrink continues. The city saw its worst first half for IPO fundraising in 28 years, almost 3 decades, with a wave of takeovers and a string of defections to US exchanges. In response, the UK government has announced the creation of a task force to help bring new listings to the UK capital. But there are some voices and examples of optimism. Since its April IPO, auditing firm MHA has seen a significant rally in its shares. MHA CEO Rakesh Shaunak joins me around the desk right now. Rakesh, you took the gamble, essentially, because this was just before the tariffs were put in place by President Trump. But there was a sense that they were coming. It's just before Liberation Day that you listed, and you took a chance on London's markets. You took a chance on AIM, and it's paid off for you and the team at the business. What gave you that relative confidence to list in the UK when you're seeing so many others considering ditching their primary listing here, moving to the US, or being the subject to takeover offers from PE?
Yes, thank you, Tom. It wasn't an easy decision initially because we knew what was coming, the tariffs and the volatility in the market. So I sat down, I literally sat in my study at home all night on the 31st, which was the date we were supposed to close, and rationalized and went through the process. I determined that the basics were right. Our business was strong. The UK economy is a stable economy, a personal view, and lots of things happening in other parts of the world. And I think we run the risk of talking ourselves down. We as a UK PLC run the risk of talking ourselves down. So having satisfied myself that the basics were right, we then discussed this as a board, and we came to the same conclusion and took it to our partners, and here we are.
And how are the board and how are investors feeling right now?
Very positive. A lot of interest. We're pleased we did it. It's a big differentiator. As you say, there's a lot happening in the market. There's a lot happening in our marketplace as well, the marketplace of professional services. And IPOing or listing under those circumstances, I think, should be an example to everybody, really. Hopefully it inspires a few more. And
you're seeing that appetite then. Do you come back to the markets at some point with another offering? Is that something that you and the board are considering?
We definitely will consider that, because our strategy is one of growth. Growth by way of acquisition, inorganic growth, investing in tech, as everybody does, for the benefit of our clients and our staff. So we will come back to the market at some point.
What kind of time frame? Is that a 2025 story or more of a 2026 proposition?
More of a further down the line story.
Okay. Yeah. You raised close to 100 million. How are you deploying that capital, particularly when it comes to AI? What are the kind of acquisitions you're looking to make? Is it acquisitions that you're using that capital for?
Some AI and some acquisitions as well. So we announced one pretty immediately after IPO. We have others in the pipeline, so there will be those. But in terms of AI, AI is not just one of those words anymore. It's something that's real, and we intend to leverage that, make sure that our clients benefit from that in terms of the quality of what we produce, and our staff benefit as well.
Back to the London markets then. Look, we have some prominent names. Wise is in the process. There's some controversy here amongst owners and previous foremost, but it's looking... previous founders, it's looking potentially to list in New York. It wants that liquidity. AstraZeneca's CEO has thought about this as well. We know that from the reporting. And of course, private equity, particularly US private equity, has played a role as well in acquiring UK-based companies. What is going wrong for those companies? What is the London market not providing those companies right now? What needs to change?
I think, Tom, a lot is made of regulation, and I think that's a story that people have different views on. I think regulation is a piece, but the lack of liquidity, and it's a vicious circle, really. Lack of liquidity because liquidity isn't there because people aren't showing their faith in it, really. So how do you stem the flow? The only way you can stem the flow is basically show your faith in the UK markets, create that liquidity. The government's trying to inject, different ideas, and the government's certainly showing very positive signs. So hopefully
they're showing positive signs. But what do they need to do specifically? Do you think, in your mind?
I think easing regulation, if that's what people are saying, is a major driver.
Things like stamp duty as well?
Stamp duty is one. The regulatory piece, as I mentioned earlier, that's a cleft stick, really. But stamp duty is definitely one. Regulation and the general compliance associated with listings.
Do you think the story of MHA and the relative success you've had since listing in April will be something of a catalyst? Have you spoken to other executives, other CEOs here in the UK who are considering listing? Do you expect the pipeline of companies coming to the market to start to improve next year?
I do, Tom. There's been a lot of interest from our peers and from other, we act for clients who have ambition as well, and listing ambition. Some are listed already. So our story, I hope, will be an inspiration to others as well. And all the conversations we've had have been very positive.
Okay, Rakesh, thank you very much indeed. And we'll see, of course, if that is what transpires in 2026. We appreciate you coming into the studio this morning. MHA CEO Rakesh Shaunak, of course, on the back of that listing back in April on the AIM market here in London, and the success of that listing, what it means for the broader London markets amid a broader downturn, of course, particularly when it comes to IPOs in the first half. Now, back to the earnings story. UniCredit raising its full-year outlook for profit and shareholder distributions after reporting second quarter net income that comfortably beat estimates. The results are another boost for the CEO, Andrea Orcel, after UniCredit dropped its bid to take over rival Banco BPM. Let's get more from Bloomberg's Italy bureau chief, Chiara Albanese. Chiara, does this mean we can expect UniCredit to continue its market-beating share performance? Before today, the stock was up, more than 50%? More than 50% year to date. acquisitions that seem the Banco BPM off the table for now. Does the market performance for UniCredit, are there further catalysts for this stock going forward?
Yes, so Andrea Orchel really unveiled to the markets a stellar performance today, but at the same time it's a mixed bag for him because some of his acquisition plans are meeting government opposition both in Italy and in Germany. Orchel said last evening that he is dropping for now a plan to buy smaller rival Banco BPM, while he's also meeting some opposition in Germany on plans to take over a bigger role in Commerzbank. Now, clearly, investors will be on the lookout on whether he is getting a lot of good cash, but how he will be able to spend it by making smart and strategic acquisitions across Europe.
Chiara, is that potential deal then for Banco BPM? They've dropped the bid. Is that done and dusted for Orchel in terms of his M&A ambitions? Are they thwarted or just delayed at this point?
So he's done for now. He's taking definitely a break from the deal to reassess, but it is definitely not ruled out that he might come back to the table with the new offer for the same target or other targets in Italy. As we said, he has got a lot of cash that he can spend and deploy on acquisitions.
OK, Bloomberg's Italy Bureau Chief Chiara Albanese on that beat coming through for UniCredit, and at least for now, temporarily at least, the end of those M&A ambitions. Thank you for the context. Coming up, a boost for Toyota and other Japanese car makers as President Trump agrees to a 15% tariff on autos imported from Japan. More details on the implications of that deal for the auto sector. That's coming up. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Japan's embattled Prime Minister denies local media reports that he plans to resign. The speculation comes just hours after agreeing a deal to cut US tariffs to 15%. President Trump's latest trade deal gives the record-breaking global stock rally more fuel as traders turn their attention to big tech earnings. Plus, in corporate news, UniCredit looks to return more money to shareholders as it drops its bid for Banco BPM, while SAP flags tariff and FX concerns as cloud growth falls just short of estimates. In the auto space, Toyota shares have gained 14%, yes, 14%, after the US agreed to lower 15% tariffs then on autos imported from Japan, ending months of uncertainty. Tesla is expected to provide, meanwhile, updates on its outlook for the full year later today amid ongoing sales declines. So, a number of factors in focus for the auto sector. 15% now for the auto sector of Japan, which is a relief, clearly, for many investors. Bloomberg Global Autos editor Craig Trudell is here. Let's start on the upside that we're seeing for Japanese automakers. This seems to have been a surprise that they seem, Japan, at least from the reporting that we have, to have locked in 15% when it comes to that key auto sector.
Yeah, I think this is all a matter of expectations, right? Where 25% was hurting, was going to keep hurting, and was really going to be painful. 15% is not by any means pleasant for an industry that was used to 2.5% duties for imports into the U.S. And yet it's much worse than it's much better than the alternative, and gives these companies a slight bit of relief and also some more flexibility to work with in terms of what sort of long-term strategies they work out in the months to come.
Yeah, and when you speak to CEOs, often they'll say it's less about the tariff rate itself. It's more about having some certainty as to what the tariff regime is longer term. So maybe that's part of the factor as well. But to your point, from 2.5% to 15% is still not insignificant. Tesla earnings coming up then. A focus on Elon Musk at a time when we're seeing the sales just continue to fall, not just in Europe, but also in parts of the US, in California. What are you and the team going to be scrutinizing from those Tesla earnings?
I mean, I think consistently now we've seen, sort of yeoman's work on Elon Musk's part to take what are really, pretty crummy numbers and, like last quarter, it was even just, explicit where he said, don't look at those, think of the sort of shining city on a hill, these, autonomous vehicles that we have coming. I think the challenge for him is that even he is acknowledging that, this is not going to be a business that is a financial needle mover, in his words, until, next year. And this is someone who, year after year has been proven overly optimistic about the prospects for his, autonomous vehicle, business. Whether or not he's able to sort of make good on that, and also, just to sort of put investors at ease that there is going to be some reason for optimism in the months to come with the sort of here and now business. When are these more affordable models that Tesla has talked about actually coming to sort of save the day for a car maker now that is steadily and sort of firmly in decline?
Okay, so the autonomous driving part for Tesla, but also the cheaper models as well, and maybe if we get any detail as to when they enter the market. Bloomberg's Global Autos editor Craig Trudell with a preview there, of course, of Tesla, but also digesting the impact across the Japanese auto sector on the back of these reduced tariffs from 25 to 15%. Now, sticking with Elon Musk, SpaceX has told its investors that the CEO could, of course, return to politics in the future. Elon Musk, of course, none other than. The company made the admission in paperwork sent to investors discussing its latest tender offer. SpaceX's most recent offer values the rocket and satellite maker at about $400 billion, which, of course, would make it the most valuable private company in the world. SAP shares are lower after reported second quarter cloud and software sales that fell just shy of estimates. Europe's most valuable company says it's been affected by insecurities over US tariffs, and the weaker dollar will potentially hurt full year cloud revenue. I've been speaking to the CEO of that company, Christian Klein.
It all depends how the currency, will develop. I mean, of course, if it stays like that, of course, we will gonna see a further currency impact, but we always guide at constant currency. I mean, this is, what we can control. And there, of course, we expect an ongoing strong business. The currency is hard to influence. If it stays like that, obviously there will be, a further impact. But again, currency, fluctuates, over the last 5 years a lot. And what really is for us important, that the underlying performance of SAP obviously stays strong.
Yeah. Is there more you can do to mitigate the FX effects in terms of hedging?
Yeah. Yes. I mean, of course, we are hedging, obviously. And then, of course, second, what we also then, of course, are doing is, again, across the geo, I mean, we are closing contracts in all parts of the world. We have huge multinationals. We can also close certain contracts in local countries. There is, of course, certain things what we can do. Again, Tom, for us, it's very important that pipeline is strong. We actually see strong execution so far in the year, and that is, of course, our main focus. And then the currency, of course, there are certain things what we can mechanically do, and we're gonna do that.
The CEO of SAP, Christian Klein, speaking to me earlier on the back of those earnings. Meanwhile, ASM International's second quarter orders have fallen 4%, missing expectations. Bookings of ASM's chip-making machines have flagged as the semiconductor businesses of some of its customers, including Intel and Samsung, cede leadership in the AI race. The Dutch company says the decline in orders was mainly due to lower advanced logic and foundry bookings, while sales of its leading-edge machines were robust. Staying on the tech space, but shifting focus to software. Alphabet earnings coming up later today. The parent company, of course, of Google. In focus will be the search business and to what extent they can reassure investors that that is defensible, as you see, of course, some of those competitors with that AI-infused edge nipping at the heels of Google search. The cloud performance as well seen by analysts as key, of course, in terms of the profit driver for Alphabet going forward and what they have to say about the strategy for their own AI platforms, particularly the Gemini model, whether or not they have any updates in terms of the progress on updating that particular piece of AI software for the Alphabet team. So those are some of the numbers. The revenue estimates then looking at close to $94 billion US. Those are the estimates for the second quarter. Those earnings later today, stateside, we'll break those for you, of course. Meanwhile, Microsoft has warned that Chinese state-sponsored hackers are among those exploiting flaws in its SharePoint software to break into institutions globally. Bloomberg understands one of those is the US National Nuclear Security Administration, which is responsible for designing nuclear weapons. While Microsoft have patched its software, cybersecurity researchers have detected breaches on more than 100 servers, representing 60 victims. So what is happening in the markets right now? Because the meme stock fever from the COVID pandemic looks to have made a return, with Coles and Opendoor the latest day trader darlings. Let's get more. Bloomberg's Valerie Teitel, you've been watching this for us. What is driving the exuberance? So this suggesting there's froth in these markets, Val.
Yeah, or maybe these retail traders that bought the dip back in April are feeling way more comfortable throwing it around. I mean, look at Kohl's shares yesterday. Closed up 37%. It opened up over 100% higher, Tom. This really interest in Kohl's, this meme stock mania. The short interest in Kohl's is around 50% of free flow. That seems to have gotten a lot of attention on Reddit. That follows on Opendoor, which shot up in the last few sessions based on a hedge fund manager tweeting about it. So it really seems we are returning to this 2020 euphoria. And Tom, it hasn't stopped. We have a new meme stock on our radar, and that is Krispy Kreme. Jumped 37% yesterday. For no new company news, it is up another 17% in the pre-market. This just goes to show how much these retail volumes are driving the the U.S. stock market. They're known to know about 20% of total volumes. But I have a statistic for you, Tom. In yesterday's session, Opendoor, 1 billion shares traded hands. Compare that to NVIDIA, only 184 million shares traded hands. And NVIDIA is known to being popular for day traders to trade along. It just shows that retail volumes have really come back.
Wow. OK, Krispy Kreme, the new meme stock. Valerie Teitel, thank you very much. Indeed. What a surge of Krispy Kreme shares, as Val was saying, on the back of no noticeable company news. Now, in the world of commodities, it is a race against the clock to beat tariffs, of course, with ships carrying copper rushing to reach US ports before the levies kick in. Meanwhile, the oil market remains in wait-and-see mode as traders look for further updates in terms of the tariff story. We'll talk about the impact maybe of that US-Japan deal. Let's bring in Michael Haigh, then, head of FIC and Commodities Research at SGCIB. That's quite the acronym, Michael. Thanks for joining us in the studio. Let's talk about the trade picture then. So we've had this deal between the US and Japan. If that gets emulated by Europe and the US, what does that mean for demand around oil?
Well, I mean, this is all very positive, obviously, because what this does is it removes a lot of uncertainty in the market. Oil really isn't that much affected by the tariff woes right now in terms of what it does to demand and GDP expectations. The market really is focusing on the supply side right now, and in particular OPEC. But, you know, any kind of positive momentum towards tariff resolution, starting with Japan, maybe going into Europe on August the 1st. This is all very positive for the demand side, but at the margin. OK, at the margin. If we get a relative normalcy when it comes to global trade, if not now, then in the next 6 months, what does that mean for the thinking of OPEC Plus? They're putting more oil onto the markets. Do they just keep going down the path that they're on right now, or do they readjust if global trade normalizes? Yeah, well, they always come out and say every time they make an adjustment, they'll rethink their policy the next month depending on market conditions. So they've surprised the market by bringing back more oil than was expected starting in April. Our expectation this August 3rd is that they'll continue to bring back their voluntary cuts through to September, and then they'll pause. So they've basically gone down this path of normalizing that situation, bringing spare capacity down to sort of 3 to 4 million barrels a day. By September, we're kind of out the seasonal demand, strong demand side for oil, so there'll be a wait and see situation when we get there.
Where does that leave your forecast for oil, the range, as we look towards the back end of 2025?
Well, so the reality, and I don't think I'm out of consensus here, is that demand continues to drop for oil. This isn't really going to reverse. I mean, countries like China used to be 700 to 1 million barrels a day of growth. Next year, we're talking like 150,000 barrels a day of growth, less than India. So there's a structural decline.
China's demand will be less than India's next year.
That's correct. Yeah.
And that story isn't going to turn around if the economy improves materially in China. That is making an assumption that the economy continues at around 5%.
Well, there's the GDP assumption, of course, that has an impact on the overall oil demand picture. But some aspects of the oil barrel, notably diesel and gasoline, have peaked. I mean, the reality is that most of the fleets in China, new car sales, 50% are EV, heavy goods trucks, powered off natural gas. So that's in a one-way path. So back to your question about where this leaves us with prices, with demand coming down, supply coming back to the market from OPEC, and there's other things going on, but net, this is quite bearish on the market. So we see oil prices in the low 60s by the end of this year. That's not too hard to say, given we're at 68 today. But I think more importantly, by the end of next year, I would see it in the low 50s.
Okay, low 50s potentially, and low 60s this year, low 50s potentially next year. Really interesting on oil. I want to focus as well on copper because, of course, we have the threat of 50% tariffs on copper being imported into the US come August the 1st, I should say. And we've seen this huge premium, almost record level, 28% premium in terms of pricing in the US for copper versus here in London on the LME. On that 50% tariff, if that gets imposed by President Trump, what does that mean for longer term prices around this key metal that feeds into that EV space and other parts of the industrial
So it's
ecosystem?
important to understand for the metals market, and copper in particular, it's always really finely balanced from a supply and demand perspective. So this market is about a 23 million ton a year consumed market. The surplus or the deficit that we might get year on year is close to about 100,000 tons. It's less than 1% compared to oil, which is more like 6% before OPEC started returning barrels to the market. So it's really finely balanced. Now, you add on top of that a situation where you're distorting flows and you're taking stuff out of warehouses in Shanghai and London and sending them over to copper. It just muddies the water, essentially, and creates these premier issues around the world. But longer term, this really shouldn't affect the outlook for copper, which, by the way, is quite bullish because on top of the traditional use of copper, we have green transition. And so when you combine those two forecasts together, what's going to happen to copper for usual kind of use, whether it's infrastructure, grids, etc., and green transition, the green transition outweighs any kind of decline you might get from traditional use of copper.
Okay,
so it's quite bullish.
That outweighs, despite the Trump administration unpicking some of the Inflation Reduction Act in the US, that's not going to be a headwind for further upside for copper.
Because you've got to look at the rest of the world. I mean, you take the US out of the equation, yes, it brings down a bit of that demand from green transition, but places like China, the rest of the world, especially Europe, this will continue.
Before we let you go, gold. You're still bullish on gold. Gold has done a lot of work for investors year to date. We're getting a bit more clarity on the trade front. Yet you see further upside for the LM metal. What are you targeting, and what is behind that gold?
Okay, so there's two aspects. There's the ETF flows and there's central bank buying. These are the two things that drive the gold price. So on ETF flows, if you plot ETF tonnage going in and out every week against political uncertainty, trade uncertainty, all these measures you have, they're basically going up and down in lockstep. And the trade uncertainty and policy uncertainty, despite what's happened today, is still 6 times above the normal levels that we would see. So if uncertainty remains, then ETF flows should remain strong. Now, on the central bank side, the World Gold Council just a couple of weeks ago came out with their World Gold Council survey, central bank intention. 93% of central bank surveys said that they expect central banks to keep buying. Now, if you take the amount of assets that are held by foreigners in the US, 62 trillion, and you do a back of the envelope calculation, you say, what if 10% goes out of the US and 3% of that 10% goes into gold? That's how you get above $4,000 an ounce. So
is that your call?
That's the call.
Above $4,000 an ounce?
By the middle of next year.
By the middle of next year. 3,425 right now on gold, above 4,000 by next year. Some really clear calls then on oil and on gold, on the yellow metal. ETF flows, central bank buying. Michael, thank you very much indeed. Really interesting on this commodity space. Michael Haigh, Head of FIC and Commodities Research at SGCIB. Thank you. Coming up, EU leaders visit Japan to deepen ties. Just as Tokyo and Washington, of course, strike that trade deal, we will ask what is at stake for Brussels. That is next. This is Bloomberg. Welcome back. We had some breaking news across the terminal right now. European junk credit risk dropping to its lowest since February of 2022. That was just before Russia's invasion of Ukraine, of course, the impact on global markets, but also the impact on inflation. This is the iTraxx crossover index. It's the key gauge of credit risk, falling to 275 basis points. That's the lowest since February of 2022. That's as investors continue to move into high yield bonds as some of those stresses in the market seem as being contained. So that is a redhead when it comes to European junk credit risk. I want to bring you another breaking line as well, this time coming on the LIBOR scandal. Tom Hayes and Carlo Palombo have their rate rigging convictions quashed. That is a redhead across the terminal. This is a panel of UK Supreme Court judges unanimously allowing that appeal, and those convictions have been quashed. Former City trader Tom Hayes, of course, was jailed in August of 2015 for his role in the LIBOR interest rate scandal, served 5.5 years behind bars. That judgment then, and that conviction now being quashed. We'll get more details for you on that story. Let's get back to what's happening in terms of European leaders on the ground in Tokyo. They're meeting with officials in Japan today. Before visiting China, the trip has been overshadowed by reports that the Japanese Prime Minister plans to resign, since denied, of course, by the Prime Minister himself, Ishiba. It also comes as Japan strikes a trade deal with the US, something that remains elusive for the EU. Let's bring in Bloomberg's Brussels bureau chief, Suzanne Lynch, with the details. Suzanne, where does the US-Japan deal leave Europe then at this point?
Well, this has definitely ruffled feathers here in Brussels, that news overnight that the US and Japan have struck a trade deal. Now, what it means for the EU, we don't know, but it certainly suggests that the mood music from Washington is a bit more positive, that perhaps Donald Trump is in deal-making mood. What that means, though, in terms of getting this deal over the line remains to be seen. Donald Trump obviously has threatened 30% tariffs on the EU. This is basically not acceptable from the EU's perspective. And this afternoon, we know that ambassadors representing the 27 EU member countries, they're meeting here in Brussels to discuss next steps. We're expecting them to discuss how they would retaliate if they retaliate. Now, it's important to say that I don't think there's any calls for the EU to retaliate before August 1st, which has become the new de facto deadline. But I think it's fair to say that the European Union is stiffening its resolve to hit back if needed against the United States.
What can we expect then in terms of the talks that are taking place right now in Tokyo between EU officials and their Japanese counterparts? To what extent can they get traction and movement in terms of closer trading ties between these two groups, the EU, of course, and Japan?
Yes, I think this is part of the broader European Union move away from dependency on the United States. And that's what this trip is about. Ursula von der Leyen, the European Commission President, has said numerous times that the EU wants to be more global and that it needs to look further afield in terms of partnerships, both on defence but also on trade. So I think both sides were quite positive going into this meeting that's happening now. We expect a readout from that any moment. But already the EU, Japan is the EU's 7th largest trading partner. There's quite a lot of trade already. Japan, obviously a member of the G7, and we do need to remember that the EU also sits in the G7 in that formation. So we're expecting more economic ties, something on security. Now, the European Union, as opposed to individual countries, is quite limited what it can do in terms of defence. But we do expect some conversations about maybe cyber, hybrid threats to Europe and to Asia, those kind of issues. So we do expect the talks to be quite positive. Obviously, the timing now is quite interesting given what's happening politically in Japan. And then we've been told here by EU officials that they will compare notes about how to deal, essentially, with the United States protectionist policy under Trump. Although it is worth noting that Japan and the EU are quite different here. Japan hasn't talked about the kind of retaliation that the European Union is drawing up in the event that the trade negotiations falter.
OK, an excellent update in terms of those trade conversations between officials from Brussels, of course, their Japanese counterparts, and, of course, what it could mean as they look ahead to that meeting as well in China, which follows, of course, their Japan trip. Our Brussels Bureau Chief, Suzanne Lynch. Suzanne, thank you very much indeed. So those EU officials heading to China after their visit to Japan. Meanwhile, German Chancellor Friedrich Merz and French President Emmanuel Macron are set to meet in Berlin to address escalating tensions over the Future Combat Air System jet programme. The dispute centres on a leadership tussle between the two main defence contractors, France's Dassault Aviation and Airbus. Let's bring in Bloomberg's Benedict Carmel, who leads our global aviation coverage, for the details on this. What is the dispute then, Benny, about?
Well, fundamentally, it's about who's in charge of this. So Dassault, which is the French side of this group, is sort of pitching itself against Airbus, which broadly represents the German side. And the French have put out some fairly robust demands saying, look, we need one side that clearly runs this program, and we can be that side because we know how to run programs. We know how to assemble fighter jets. They have the Rafale jet that is flown in France and in some other countries. So we know how to do these things. Yes, this is a group of companies involved. It's us, it's Airbus, it's Spain's Indra, but we clearly need one side in charge, and that it should be us. Not surprisingly, Airbus is saying, well, not so fast. You know, we also want to have an equal voice in this. So this has turned into an unusual public spat. Normally, companies try and resolve these disputes quietly behind closed doors and in an amicable way, but instead, this has very much burst into the open. It happened last month at the Paris Air Show, Airbus complaining that a long agreed sort of arrangement was being torn up, and then Dassault doubling down saying, look, if you don't have it our way, we might just walk away from this entire project. And that's where we stand right now.
OK, a great update in terms of that dispute, and we'll see if it gets resolved. Bloomberg's Benedict Carmel, who leads our global aviation coverage, of course. Benny, thank you. Let's bring you back to the update in a stunning reversal in terms of the fate of Tom Hayes, the former UBS trader who became the face, of course, of the libel rigging scandal, seeing his criminal conviction overturned at the UK's top court, clearing his name a decade after he was sent to jail. We continue, of course, to bring you the details on that story, of course, through our programming. Bloomberg Surveillance will be speaking, meanwhile, to US Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick, and later former Ambassador to Japan, Senator Bill Hagerty, will discuss the US-Japan trade deal, of course, and maybe the EU deal. That's coming up. This is Bloomberg.